Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
You're listening to the SDA Housing Podcast, a show that explains, highlights, guides, and brings awareness about all things SDA in this ever-changing NDIS world. And today we have a return guest speaker, Paul Grant from Access Lending. Hi, Paul. How are you?
Hello, Debbie. Nice to see you again. It's been a while.
It has been a while. And I think that you've been very busy trying to negotiate changes in the SDA lending space. And today, I believe you have lots to tell us with updates of where things stand at the moment, what has been going on.
Oh, Debbie, no, if your listeners could see me, you'd wonder why I'm going grey. A lot has changed. There were a lot of changes in October last year.
There were.
More changes in December, more in January, and some more to date. Now, I'll go back a little bit. So in January, the lender who specialises in SDA brought in postcode restrictions throughout Australia, as you're aware of a lot of those restrictions. And they brought in some income restrictions for what clients need to be earning. So they were really trying to crack down on investment lending because their book has a lot of empty homes in poor/regional locations, so minimum populations, poorly designed homes, i.e. 4-bed robust properties which are sold to clients to be fully tenanted, and oversupply in locations as well. Oversupply. So they did a full analysis of their book and brought in these restrictions. Further to that, as of yesterday, I sat in on a webinar they conducted with the General Manager of Credit at this lender. And the up-to-date news is very good if you are an owner-occupier participant wanting to buy yourself a property, or if you are a family member wanting to buy one to put in, your daughter, your son, your sister, your grandma, whatever. The news is all good for you, and I'll probably come to that at the end with the good news stories. So the changes are lending to investors has become tough. The lender is looking for sophisticated investors. And what is the definition of a sophisticated investor? Apparently with ASIC, it is a minimum household income of $250,000 and a minimum net assets of $2.5 million. Now that can be and or. You don't need to have both. The reason they've brought that in is to help investors who understand investment, have done it before, maybe in the standard residential space, who have the capacity to buy an NDIS property, either be established or construction, and handle the loan repayments whilst it's possibly vacant. Okay, so a normal couple who have their owner-occupier home, have a couple of $100,000 in the bank, have never invested in real estate before, this is not designed for them. They're looking for people who are experienced investors, have dealt with vacancies before, and have a higher net worth to be able to handle the intricacies of the SDA space where it might be empty for a while. It could be tenanted and there's a lag in the rent being paid. So there's all those sorts of things that they need to be able to handle, which obviously you guys specialise in that stuff as well.
Yeah. So this is where I thought that we were pretty much in January. Yes.
So what's changed since then? So back in January, there were postcode restrictions, and those postcode restrictions could have been 10 k's from Melbourne, 15 k's from Perth, 45 k's from Adelaide. There was no kilometrage restriction on these postcodes. It is now black and white kilometre distance restrictions. So,
oh, really? Because I thought there was also those guidelines. I think there was postcodes, but it was also no further than 35 kilometres from the CBD.
It was very grey.
Yeah.
Very grey. There's parts of Perth that were 8 kilometres from CBD that were blacklisted.
Yeah.
Because they were deemed to have an oversupply.
Yeah.
Yet we had SDAs send us in due diligence reports to say, I will tenant this house very quickly because of its location. So there's a contradiction there. It's been changed. Sydney is the buzzword. This lender wants to lend in Sydney. They do not have any supply issues in Sydney. So
Great.
you can buy a SDA established or do a construction in Sydney, 50 k's maximum from Sydney CBD.
Okay.
That also includes Parramatta, Penrith, Newcastle and Wollongong. So as long as you are 50 k's inside of the distance from Sydney CBD or a part of those major regional centres, you are going to be okay.
That is really good to hear.
Other capital cities, Melbourne, Perth, Adelaide, 25 k's from CBD. So I live 45 k's from Perth CBD. If you want to buy an NDIS property where I live, which has a population of 180,000 people, you cannot get one. It is 25 k's restriction.
Is that Brisbane as well?
As Brisbane as well.
Yeah.
So
Okay.
Sydney's the flavour of the month. All the other capital cities are 25 kilometres from CBD. Okay.
Right. Do we still have postcode restrictions?
No.
Oh.
No. So all pretty well, most of those postcodes that were restricted probably fail anyway. Some of those parts of Outer Melbourne, Clyde, etc., and some of the parts of Perth fail in the distance
Yeah, that's
anyway.
true.
So they've captured them anyway.
Right. What about other regional centres? As an example, here in Queensland, Townsville and Toowoomba.
Yes. So if you are outside of the 25 k's and in a regional centre where there's a population of 10,000 or close to a major town that has a population of 50,000, and there's lots of those, what they then do is they will lend based upon the alternate use value.
Right.
So I'll quickly talk about that. I'm not a valuer. So an NDIS property, house and land package to build, let's say it's worth $1 million. That's based upon the discounted cash flow ratio, which is the income it's going to possibly earn determines its value. That same house in that suburb, if it was a normal mum and dad residential house, 4-bed, 2-bathroom, might be worth $750,000 because it doesn't have the income earning capacity. So in those regional towns, the smaller locations, they are now lending 80% of the alternate value.
Oh, wow. Okay.
If you've got a $1 million property in Toowoomba, its alternate use value is 800, they're going to lend you 80% of 800. So it means your clients are putting in a lot of money. That's what, $620,000 loan on a $1 million property. Okay. In the capital cities, so within 50 k's of Sydney and within 50 k's of Brisbane and Perth, they are still lending on 100% of alternate use. So historically, we were doing 80% of the DCF, so $1 million property, we would lend 800. If the alternate use value is 800, we're laughing. We're still okay because they're lending 100% of alternate use.
Right.
If the alternate use is 700, they'll lend 100% of 700. So sometimes there will be a shortfall. So obviously the better locations, the better suburbs, the alternate use value
It's going to be
will be higher.
Yeah.
That is black and white gospel. Okay, 80% in regional towns, 100% alternate use in the capital cities. If you are an owner-occupier or family member buying for a fellow family member, those restrictions do not apply. You can still go to 80%, occasionally probably some owner-occupiers, at 90% of the DCF. Okay, so that's the market they want because they are guaranteed tenancy.
We have been looking at this a lot recently, and I think the awareness amongst the community now is that it is possible to buy your own SDA home. The lending restrictions are far less. So
And several of them.
I know you've done quite a lot of them.
I was even speaking to someone at the lender today who said if they're an owner-occupier moving forward and we've got their care plan which shows what they're entitled to regarding housing accommodation, they may well look at putting them into their prime product. So they won't be in the SDA commercial product. They'll get a normal residential home loan. And it's
Interesting.
not guaranteed, but it's something when I get my next one, we will put to them to say, this guy's working, this girl's working. They're buying for themselves. Here's their care plan, which, as you know, is guaranteed. There's no vacancy. They'll consider putting them in as a normal home loan, which will save them a lot of money on interest and fees.
Absolutely. What would be the difference?
Or
Today's rates.
from a 7.3 down to a 5.79.
Wow.
Yeah.
Yeah. This is substantial.
Yes. Other changes. Obviously, as you're aware, you've been doing these. SDA due diligence reports are now compulsory and they're done up front. As we know historically, when investors were sold properties, they weren't advised or allowed to speak or seek SDA assistance up front. Now it's got to be done up front. So they will come to you and say, I want to buy this property. The lender will say, right, no problems. Debbie at NDIS will organise a due diligence report for you so you can see the likelihood and the timeline it's going to take to tenant that property in the location and what its amenities are and demand, etc., etc.
Okay, so this due diligence report is not a report that needs to be done by a accountant or a financial advisor. It is literally just a data report.
Correct. Which
Okay.
predominantly has been done by SDAs in the past.
Providers, yeah.
Or those who specialise in the industry who have those statistics. An accountant wouldn't know.
Yeah. All right. So that
Also, with SMSFs.
Yep.
So SMSFs, as we know, can do these as well. They must get financial advice. That is compulsory.
Mm-hmm.
That you have financial advice up front so that you know what you're getting into. Because as an SMSF, if you've got an empty property, you're not getting any rent. If you then have moved into retirement phase, that rent is your income. So it is compulsory for an SMSF to have financial advice up front. So everything is being pushed towards the buyer being fully aware of what they're getting themselves into before they commit to the transaction.
Okay. This is just really, I guess, clarification of what we've been seeing in the last couple of months anyway, isn't it, Paul?
It is definitely. A lot of investors were sold the dream, and the dream is not impossible. It can happen, but it possibly wasn't done in locations that they should have done it in. As I say to investors when they speak to me on the phone regarding a possible deal they want to do, where would you put your son, your daughter, your mum? You know, if she currently lives on the Gold Coast, why would you move her to Hervey Bay? And that could happen all over Australia. I just use those two suburbs as an extreme example. So investors need to understand and do their homework that where would they want to live? The stranger who's going to rent their house is no different. You know, they all want to do the same things, be close to the shopping centres, the surroundings that they're used to, and not too far for family to have to go and see them. So if you plan that ahead, I mean, your opportunity as a tenant, the location's the key. You might need to pay more to get closer to the capital cities and closer to the amenities, but your opportunity as a tenant is far greater. On speaking to SDAs, the closer you are to the major areas, their comfort factor of tenanting for you is far better.
Absolutely. I want to go back to some of those other regional areas as well, because we're seeing what's currently for sale at the moment, which isn't, there's not a lot out there that is in good areas. And it's really hard to find anything. We do have apartments and stock coming up in certain areas that we think are pretty good still, such as the Sunshine Coast and the Gold Coast, Southeast Queensland. So I'm wondering how they're affected by the distance restrictions.
Gold Coast is fine, and Sunshine Coast, it all depends. They do have some oversupply in the Sunshine Coast, so it might be a case-by-case scenario. And look, back in January, parts of the Sunshine Coast were blacklisted. I had an SMSF deal that settled, and one day later, the guy had a tenant.
Yeah,
in a blacklisted postcode. So if your client's wanting to buy in one of those locations, the SDA due diligence report is very important. The more favourable that report is, the more likelihood the lender's going to say, okay, it's a bit outside, but the SDA is comfortable. They'll check their books to see how many they've got there, how many are empty, and if it's not deemed excessive, then they'll say, yep, okay. And again, the client's profile comes into account as well, as to how much have they got in the bank.
And what their buffer would be.
All that comes into it as well.
Yeah. Okay, so was that it for the changes, for the clarifications?
What investors need to know, and obviously the owner-occupiers and the family members, is back in January, a lot of brokers and some lenders pulled out of the market. It became too tough. The rules were changing daily, and it just became hard work for them. So there's probably not as many people who are now writing SDA loans as there used to be. And if you're still using a broker that says they're going to the major banks, you're still wasting your time. There are only 2 lenders that specialise in this space. Their policies are very similar, and you need to speak to a broker or a mortgage manager who specialises in NDIS. And obviously, Debbie and her team have access to people you can speak to. But yes, please don't go to a broker. Your broker could be very, 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 very good at selling home loans, but ask them, have you written NDIS loans before? How many have you written, and when was the last time you wrote one? And are you afraid with the current policies? And if they say yes, go for it. All good. But if they've never done one, then you might say, look, I'm glad you look after all my other stuff that you've done for me, but I need to go and see somebody who specialises in NDIS.
Yeah.
Please bear that in mind.
Absolutely 100%, Paul.
Save you a lot of time.
Yeah. Yeah. And look, we do explain that to a lot of people that call up and they're asking, and they've got pre-approval for a regular home loan, and the first thing we'll say is, well, that is all well and good, but this is a very different scenario. And they'll say, oh no, that's fine. I've been with my bank for years and blah blah blah. But I'm glad that you brought that up, because I just want to iterate again to our listeners, it is a whole different ballgame when it comes to this.
And some banks are now starting to take on SDA deals, Debbie, as refinances. So after your clients own the property for a couple of years, they've had rent coming in, it's in their tax returns, there are some banks who are now taking those deals and doing them as normal home loans, because they can see the numbers. And particularly, bear in mind, they also then value it as a residential alternative use value. If that value's increased from when you purchased it, the numbers could be very similar. You might have bought it for $1 million, it's alternate use, 2 years later might be in the high 9s or close to $1 million. You're going to get yourself a residential loan because your rent's in your tax returns.
Yeah.
So, you don't have to pay the high commercial rates forever. Once you've got it tenanted, you'll have options for you.
But initially, it's going to be a whole different ballgame. Yeah, totally. Okay, so can we just summarize those changes that have been implemented? And we're talking, as we're recording this, we're in the last week of June, by the way. So I'm not quite sure when we're going to get this episode out. We'll get that out as soon as we can. But so the postcode restrictions are gone, but it's now all about distance from the CBD.
Correct.
So Sydney being the flavour of the year, which we know, we've been very, very bullish on Sydney for some time now. 50 kilometres from the CBD. Newcastle and Wollongong are also great.
Parramatta and Penrith as well.
And Parramatta and Penrith, absolutely. And the other main cities being...
capital cities, 25 kilometres.
25 kilometres. So we're talking about Brisbane, Melbourne, Adelaide, Perth. And if we're talking more regional towns, it's got to have a population of 10,000.
Yes, and within 25 k's of a major regional with a population of 50,000.
And 25 k of a 50,000 population. Okay, so that's good. And if it's because previously the restriction was if it was up to 20,000 population, you had to be no more than 5 k's.
Oh, it changed, yes.
But that's changed now. So if it's within a decent distance of a 10,000 population town, it will be considered.
We'd have to challenge it.
Yeah.
As to.
So, okay, that's good. So that's for the regular sophisticated investors. That hasn't changed. But the owner-occupiers now are looking at getting it easier.
And the investors who are buying for family members?
Same kind of, we sort of...
They're not bound.
Yeah, we kind of classify those as owner-occupiers, even though they're not officially, but it's the same situation.
And the other change was regarding the valuations. They are now no longer working off 80% of the discounted cash flow value. It's now 100% of the alternate use value in the cities and 80% of the alternate use value in regional.
Okay. And this is for the owner-occupier buyers.
That's for the investors. The owner-occupier.
This is for the investors. Okay, sorry.
Restrictions. There's no restrictions.
Clarify
for the
that.
owner-occupier.
No restrictions for the owner-occupier, of course.
80% of the DCF, or if you're an owner-occupier, we can even push them to 90%.
Yep. And And as you said, there is maybe the potential of getting them a regular residential loan.
As an owner-occupier, if their care plan shows their housing allowance, yes.
Yeah. That is really good.
I haven't tested that one yet, so if you can send me one, I'll test it for you.
We'll see what we can do. Hopefully we will have some owner-occupier or family deals coming your way.
And look, the other ones were the sophisticated investor, so the definition being household income of 250K and or net assets of 2.5 million. Now, we have actually tested that one. So you'd be a mum and dad with 3 kids earning 250K with a mortgage and a car loan. We've just got one assessed for a single applicant with no other debt at all. He's 24 years of age. He's got $220,000 income. He's been accepted. So see what I mean? Hey, the 250 is the guideline, but they've got more commitments than him. So he's got more disposable income than them. So I wouldn't suggest putting one in at 150. I'd be wanting to be over 200. And again, the circumstance would need to be explained. So it's black and white, but still grey.
Absolutely. So, okay, so that hasn't really changed. I think last time we were speaking about the sophisticated investor criteria to qualify in there was a little bit of grey area, which is understandable because, they've got to look at each individual posts and circumstances. But it's just good to hear that sort of has remained. And it's what it should have been a long time ago.
All along, yes.
Yes.
We're finding the people who are not in hardship are in that box.
Yeah.
Right? They might be feeling it in their personal situation, but the ones who are in hardship were the ones who were their first-time investors with a lot less income, and servicing was based upon the proposed full tenancy of the property. So it hasn't happened for them.
It has not happened. Much slower than everyone realised.
And look, and to give you an example, the alternate use value is not a bad thing. We're just doing one. I've got 3 at the moment where the SDA value, one of them in Perth was 1.2. So 80% of 1.2, and the alternate use value 18 months ago was 750,000. We've just got it revalued. The alternate use value is now 1.1.
Wow.
And the original loan amount was going to be 936. So on the original alternate use value of 750, they were short. Now the alternate use value of 1.1, we can happily give them the 936. And so the alternate use value has gone up for those construction deals that have taken a long time to get to fruition.
That's true. Yeah, and there's been a lot of those.
Yes,
a lot of those, especially in the Perth market, Paul.
The news is not all bad. The alternate use value at 100% could be better than 80% of the DCF value.
Yeah.
In some circumstances.
Yeah, absolutely. I just want to go back and clarify too about the due diligence and the financial advisors report needed for SMSF buyers.
Yes.
So, because we had this conversation, it was a couple of months ago, one of our buyers who had purchased 2.5 years ago in Perth. It's taken this long to come to completion and to settle finance. Because it was an SMSF deal, they required a financial advisor's report.
Yes.
Just to clarify that they have received financial advice and that the investor knows what he's doing.
Yes.
And now that's needed up front.
Yes, and it's got to be detailed, particularly if the client has pulled all their money out of industry super to set up the SMSF purpose of doing NDIS. The financial advisor's got to explain, if they've had an SMSF for 20 years, it doesn't matter because they get advice on all different sorts of investments. But if it's been set up purely for the purpose of buying an NDIS property, the financial advisor's got to include that the client has been made aware of the risks in investing in NDIS for them to get over the line.
Yeah, so this is a full statement of advice?
Yes.
From a financial advisor? Yep.
Which is money, but you've got to pay for it. And I set mine up 10 years ago and I had a statement of advice given to me back then. So
absolutely.
Compulsory, I would have thought.
Yeah. So the statement of advice, the due diligence report, which is generally going to come from an SDA provider. Does it have to come from an SDA provider?
No, you do them and you're not an SDA provider, are you?
Okay, just checking that still.
Obviously, as I said, it's got to have the industry analysis for someone who can collect that data, which obviously you know how to do, which is what the lender's looking for. They're wanting to know the population, amenities, hospitals, likelihood of tenanting, how many is there an oversupply, undersupply in certain categories, and if you're able to do that, which you are, they've been accepting your reports all the time.
Fantastic. Good to hear. Okay then, Paul, was there anything else that you wanted to just
Some
touch on?
changes come through.
Yeah.
As far as marketing goes, look, we used to write probably 20 investment deals a month, and there might be 20 other companies just like us doing the same thing. We're probably now only doing a couple. Restrictions have limited it.
There's also a lot less stock out there for sale.
Yes. But the lender is very keen, and they have said this in the webinar yesterday, very keen to support owner-occupiers.
Great.
They want that market. It's obviously good for them, and it's obviously helping the owner-occupier as well.
100%. Yeah.
They want to help those people.
Great. Okay, Paul. Well, I think that wraps it up.
A bit messy there for a while. We've got there.
Absolutely. Well,
Brisbane and I'm in Perth, I suppose. It's a long way.
it's a long way across the Ethernet. Absolutely.
All good, Debbie.
Yeah, well, thank you very much for that update. Good to get it straight from the horse's mouth, as we have literally, as you're on the webinar yesterday with the lender.
Yes.
So thanks, Paul, for your time. Appreciate that. And hopefully there won't be any more big changes soon, and we'll it'll stabilise, shall we say.
Well, if there are changes, at least be positive ones, not negative ones.
That's right, yeah. And look, it's all going to be good for the industry. It's going through a rough time on many different levels at the moment, but I think these changes are all just going to improve things in the long run.
Sounds good.
Absolutely. Okay, well, that is it for this episode. So thanks, everyone, and until next time.
Thank you, Debbie. I'll see you again.
So this is just a little add-on to the episode with Paul. I actually totally forgot to ask him what the lending restrictions were if they changed for built and tenanted SDA properties. Now, Paul's answer was they are still bound by the same kilometre distance requirements. However, for servicing, the lender won't use proposed rent anymore unless there's a good SDA report. Otherwise, they service it on the standard rent. If you have a tenant, it will be serviced based upon that tenant's rent. So back previously when lenders used to service based upon full tenancy or a percentage of that, that is no longer the case. It is only based on one participant. So that is another small change to the lending restrictions. I hope that everyone got something out of this. If you do have any questions whatsoever, please feel free to reach out to us here at info@ndis.property, or you can give us a call 1300 254 397.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.